Joining us right now to talk about this and more, William Foster, Moody's Vice President and Lead U.S. Analyst, and Jurrien Timmer is also here, Director of Global Macro at Fidelity Investments. Thank you both for joining us. You look at this deal, non-deal, what is it? And how should investors even think about it?
Right. Well, I think it's a step forward, but it's, we can't expect too much. And obviously we're seeing that right now from China. Fundamentally, we see some progress in terms of pausing on the tariff front, but we still have the core issues that are still at stake: intellectual property, technology transfer.
But so did it make sense for the market to move the way it did on Friday? Or was that just, there was a knee-jerk, weird...
This is what we've seen, over the last several months, right? And any positive news,
right?
Yeah, positive response, negative news, it's the opposite. So I think that's, we've come to expect that, but the substance of the deal right now is obviously not there. So we're gonna see more of this moving forward.
Jurrien Timmer, did you know that this was a head fake on Friday?
Well, even a skinny deal is progress, right? So if we can save Christmas over here by delaying or postponing tariffs, the Chinese clearly need to buy a lot of ag products because the African swine fever has wiped out the livestock, and they need to rebuild that. That requires a lot of feedstock. So it's clearly in everyone's interest to do something, but still the notion of an all-encompassing deal that fixes everything is, I think, extremely unlikely. And so there will be other iterations, right, other chapters in this story over the coming year or so. But for now, this creates some visibility, and I think it would be
It creates visibility into what, though, for real? Just this Christmas situation.
Tariffs matter, right? It certainly matters to profit margins, to consumer prices. So even if they're only delayed and not completely taken off the table, it buys companies some more time to maybe re-engineer supply chains. And we'll probably see the same thing with companies guiding lower and then beating those lowered estimates.
Is this a de-escalation, or is this just a freeze on potential additional escalation?
It's probably the same thing, right? A de-escalation by not enforcing the new tariffs, which are going to hurt a lot more than the last tariffs, and getting the ag purchases. Ag purchases by China from the U.S. are running at half previous years, so it does matter. But ultimately, we have to wonder, what the end game is, and the end game probably is a long one.
But one of the things that's been fascinating in terms of what stocks have been working, even on Friday, when the news was better. Everything moved, obviously, but clearly everybody's still in a defensive posture, which is to say, is there any pocket of the market that wouldn't be a classic defensive stock that you think should be working, or a sector that should be working right now?
In the end, this is really about what you expect to have. How bad is this trade situation going to be? Will there be escalation moving forward? And certainly there should be pockets of opportunity, but in the end, our view is that you're going to continue to see this. This basically buys more time for the two sides to try to come to some kind of agreement on some of the core issues, and that will just give the market more time to kind of digest, and hopefully not basically puts a baseline in there where the Fed can help as well.
Shares of Caterpillar were up pretty sharply.
So you have the structural trades. The bond proxies, to me, is part fear of recession, and everyone's been fearing a recession for years now. It's like everyone is still looking for the big one, and it hasn't come, and now the Fed actually is starting to add balance sheet expansion again, so maybe it won't come. But part of it is also demographic, the search for yield. Utilities, earning a 20 multiple makes no sense unless you are filtering it through that lens. But I think if we stave off a global recession, then certainly the banks and other cyclicals should at some point really start to shine. And banks have very, very robust cash yields at this point, so they are getting more attractive.
Like banks. Nobody likes banks. Nobody's liked banks for years.
Nobody likes banks, but if you can get past this late cycle phase and back into sort of an early cycle phase, then typically the banks do okay. The yield curve steepens, even though short rates are lower.
You have a final word on that?
No.
You're going to leave it to Jurrien. Okay. William, thank you. Jurrien, thank you.
Thank you.